Hello friends and subscribers, welcome back to another edition of Readings in Impact Investing. My name is Daniel Rosehill and this is a YouTube channel and a podcast consisting of me reading important reports from the world of impact investing. Today we're going to be continuing with the GSG report from this month, although that will shortly be dated because we're at the end of December already. This came out in December 2023. The report that I'm reading from is called Time to Accelerate Capital Mobilization for the SDGs in Emerging Markets. And this chapter is quite long, but it's also the last chapter of this report. So once we're finished with this, I will conclude this reading. There is a glossary, but I'm not going to read it because I think it would be duplicating a lot of the same glossary in the previous report, ITF State of Play. And that is at the end of that video, and the video should be timestamped, so you should be able to just listen to the glossary if that's what you want to do. All right, so let's read this chapter 3. Domestic EMDE actors and initiatives are leading the way. And just to say that there are some tables which I will not be reading because that is just too detailed. But if people want to read the report, it's up there as a PDF on the GSG website. And if I ever refer to page numbers, I'm referring to page numbers in the printed edition because that's what I'm reading from. And those may differ slightly from page numbers in the PDF digital document. Key messages. SMEs are critical to the achievement of the SDGs, but inherent real and perceived risks need to be addressed. Domestic pension funds and PDBs are underutilized sources of capital and must be incentivized to invest more in EMDE alternative investments. EMDE impact fund managers have local knowledge that can channel capital into SMEs, but require greater investor support, specifically in the form of catalytic capital. Stronger regulation, including definitions of SMEs or incentives towards formalizing businesses, is essential to encourage domestic capital to invest locally. As we have explored in Chapter 1 and 2, the financing gaps to achieve the SDGs and a just transition are staggering. So far, our report focuses mostly on the need to mobilize more capital more effectively from developed markets to EMDEs and how it can be done. With needs so great, all actors are called upon to play a role. In some EMDE, there are large, fast-growing pools of domestic institutional capital, which can also be harnessed to meet the needs of a changing planet. The following chapter examines notable developments in the domestic EMDE landscape that can help unlock institutional capital for the SDGs and a just transition. We explore the case for mobilizing domestic sources of capital, referencing recent initiatives that are helping to engage those investors with impact investing and global issues, and suggest opportunities for greater collaboration between domestic actors, MDBs and DFIs. Domestic capital providers, including pension funds and public development banks, PDBs, are well placed to invest in homegrown assets, helping to drive development in their home markets. While pension funds in particular are being given greater ability to invest in alternatives, many lack understanding of this asset class, with the GSG and its national partners working to bridge this education gap. Local fund managers also have a central role to play. They have unparalleled local knowledge and the ability to invest in SMEs that are critical to the achievement of the SDGs. By supporting them in their fund structuring, fundraising, and other fund operations, we can in turn strengthen the investment opportunities and business propositions for domestic institutional investors. Once again, international DFIs and MDBs can contribute to the overall capital mobilization agenda with guarantees and first loss capital that can de-risk investments and serve as a catalyst for domestic institutional investors. Mobilizing domestic EMDE actors is a priority for SDG financing. Since early 2021, the cost of capital has increased across the globe as a consequence of monetary tightening to address high inflation, making investments into EMDEs less favourable for investors in developed markets. The increasing cost of capital from international markets adds to the urgent need to unlock pools of domestic capital that can be invested in local currency. Mobilizing these sources of capital will be essential for meeting the SDGs and supporting a just transition, and can address several factors, including advancing opportunities that are locally led. Domestic capital providers know and understand their own local market context. In many cases, in fact, they are better equipped to direct capital to where it is needed most. Providing access to capital in local currency. In today's rapidly shifting macroeconomic environment, local currency is less susceptible to foreign exchange risk. Having the ability to access local funding adds a layer of protection for domestic borrowers and investees. Unlocking domestic institutional investments starts with pension funds. While rising interest rates and inflation in the last 2 years have made investing in EMDEs more challenging for developed market investors, domestic EMDE asset owners and institutional investors in certain countries have been experiencing increasing profitability. As referenced by the IMF, institutions with longer-term financial obligations, such as insurance companies and pension funds, have benefited in certain respects from elevated global interest rates, which in some instances have reduced the present value of liabilities, improving their financial status. With the majority of beneficiaries of domestic pension funds far from pensionable age, these funds are well positioned to consider longer-term investments tied to the real economy. In recent years, new push factors stemming from government debt defaults and debt restructuring have created even further impetus for pensions to seek to diversify away from treasury bonds and invest more into alternative assets, including infrastructure, fund of funds, and SME financing. Investing domestically in real assets provides institutional investors with an opportunity to contribute to national growth priorities while supporting social and environmental resilience in the long term. EMDE institutional investors are increasingly being called upon to contribute to countrywide priorities referenced in their national development plans or comply with newly adopted ESG, sustainability or climate regulations introduced by local regulators, capital market authorities and/or central banks. These factors and others have led to a loosening of asset allocation limits to alternatives in select jurisdictions, such as South Africa and Colombia, that are paving the way for greater investment into alternative assets, for example, renewable energy, infrastructure, climate technology, and more. While limits are being raised, in practice, many EMDE pension funds invest only a negligible percentage into alternatives. For example, in Ghana in 2020, less than 0.03% of pension assets were invested in alternatives, despite a regulatory limit of 15%. Domestic institutional investors are very new to alternatives as an asset class, and most are still very far from utilising their full allotments. Through direct engagements with domestic pension funds, the SDG and affiliated NABs are working to bridge these knowledge gaps and familiarise pensions with alternatives, and within this, the growing cadre of SMEs aligned to the UN SDGs as an asset class. Through its engagements, the GSG and NABs have learned that, in order to move forward with allocations, domestic actors require better access to information, including investment and performance data, access to case studies and peer support, as well as access to the domestic investment pipeline. To meet these needs, the Global Steering Group, NABs, partners and other global stakeholders have worked to set up industry collaboratives and peer-led support networks. In 2022, a consortium of international partners, including WEF Global Alliance for Social Entrepreneurship, Collaborative for Frontier Finance, the GSG and Sustainable Development Investment Partnership, worked closely with local market building organisations including Impact Investing Ghana, the Zambia National Advisory Board for Impact Investing and Impact Investing South Africa, as well as pension fund collectives in 3 countries, in order to identify common barriers and solutions and develop investment pipeline opportunities. The World Bank and select DFIs have also been active in this domain, setting up collaboratives in Kenya, South Africa and the Asia-Pacific region to familiarise pensions with infrastructure, real estate, private equity and venture capital investing, while sharing due diligence responsibilities, reducing transaction costs in smaller deals and increasing investor confidence in new geographies. With new knowledge and skills, these collaboratives are already playing an important first mover role that should be further leveraged to grow allocations in investments linked to the real economy. Nationally determined contributions and thematic areas identified in EMDE national development plans linked to the SDGs. Public development banks are the most evident and underutilised partners to mobilise private capital. Given the current monetary tightening in advanced economies, development experts have continued to consider how international public development capital can engage with local institutions to leverage and mobilise local pools of capital. Building PDBs in emerging and developing economies into the international policy framework for climate and transition finance will support private capital mobilisation due to their knowledge of local markets, needs and capacities, as well as their long-held relationships with stakeholders. As ODI lays out, PDPs can play roles as mobilisers, blenders of concessional finance, pipeline developers and policy influencers to help remove barriers to capital mobilisation into emerging and frontier economies. Recognising the need for more collaboration between DFIs and PDPs in 2020, the French development agency AFD launched Finance in Common, a network representing PDPs and DFIs with an aim of making PDPs more visible and strengthening their role in financing the SDGs. There are 450 PDBs around the world, roughly one or more per country. Just a quick reminder, because there's so many acronyms in this. PDB is a public development bank and a DFI is a development financial institution. Through varying widely in size and mandate, they manage over $23 trillion, that's the PDBs, representing perhaps one of the least well-known yet well-placed groups of organisations for economic development. Despite their ability to deploy de-risking instruments and act as catalysts for private sector investments, most PDPs lack experience in collaborating and co-investing with private investors to support the implementation of national development strategies or structure innovative financial vehicles towards the SDGs at a national scale. Strengthening collaboration with PDPs in EMDEs can further boost domestic private capital mobilisation and more specifically SME finance due to their knowledge of local markets, as well as long-held relationships with stakeholders in those markets. A 2023 Finance in Common paper, The Role of Public Development Banks in Scaling Up Sustainable Financing, lays out key recommendations to get PDPs more focused on supporting the SDGs and a just transition, including aligning PDB mandates, strength strategy and governance to the SDGs. Introducing data management, measurement and impact taxonomies, and pursuing effective collaboration and international support. Actions which can enable PDBs to more readily scale sustainable finance. PDB mandate, strategy and governance aligned to SDGs. PDB's mandates and activities should be aligned with the Paris Agreement and SDGs through the right incentives, as well as with the national or subnational government policies. An integrated approach towards the SDGs, combining a negative screening with positive impact assessment, should be pursued at both a strategic and a project level. Lending and guarantees, pricing and currency risk. Enabling PDPs to access lower costs of capital would support their longer term and lower cost finance. Specifically, reducing the cost of currency risk for PDPs is vital. Finally, effective collaboration and international support. Collaboration with the private sector potentially helps evolve PDP's business models aligned with future needs. Commitment from the development community, including the G20, also supports their mobilisation. Domestic initiatives are underway to finance SMEs. One area where both domestic EMDE pensions and PDPs can play a strong role is sustainable development and market building is by supporting the growth of small and medium enterprises or SMEs. Supporting micro, small and medium sized enterprises in EMDEs can play a significant role in promoting inclusive growth and building resilience in the face of macroeconomic shocks worldwide. SMEs account for 50% of employment and contribute up to 40% of GDP in some EMDEs, but they have an unmet financing need of $5.2 trillion per annum, equivalent to 1.4 times the current level of global SME lending. Building domestic capability and capacity can help support small and growing businesses that are often overlooked by investors. In this section, we focus on opportunities to build the capacities and channel capital to domestic SMEs that contribute significantly to employment and local development outcomes. Supporting SMEs is still the most important yet most challenging priority for achieving the SDGs. Without SME growth, EMDEs cannot achieve economies that work for all and a just transition. SMEs need access to affordable finance for working capital and business growth. They also require other support mechanisms to increase their chances of growth and positive impact, and to qualify for, receive and manage loans and investments as required. On the demand side, inherent real and perceived risks facing small and early stage businesses hinder financing. See box 24, which we'll cover next. These inevitably inform supply-side challenges, leaving financing needs unmet and opportunities gravely overlooked by investors, both international and domestic. Box 24, demand-side risks to address to facilitate greater credit flow to SMEs. Information asymmetry challenge. SMEs may present little to no visibility of their cash flows, past performance, nor how financing is used. This increases the perception of risk among commercial banks, who in turn attribute a credit score higher to the business, to the detriment of the SME borrower. Performance risk. SMEs may lack access to accounting or financial expertise to know how to pay back the loan. In addition, high interest rates in some countries confine lending to trading activities and fail to support the growth financing needs of small businesses. Resilience risk. Factors outside the control of the SMEs may hinder their ability to pay a loan, such as climate, currency, or other conflict-related risks. Recovery risk. In instances where SMEs cannot cover their monthly payments, collateral is seized at a high cost to borrowers. Some SMEs also lack collateral to begin with, preventing them from being able to access commercial bank financing. Keyman risk. In certain instances, SMEs are not well structured and do not have the proper governance in place, creating challenges for lenders or investors to ensure accountability in the face of bankruptcy or other risks. The solution to meeting the financing gap is a holistic one. It involves implementing varied solutions geared towards reducing or mitigating demand and supply side risks, both real and perceived. On the demand side, small businesses must improve their management and operational capacities, including being able to present balance sheet and cash flow statements, invoices, payroll, staff training, and more. On the supply side, lenders and investors must begin to gather data on client businesses and the wider value chain, enhance credit risk scoring mechanisms, build skill origination teams, and hone lending and investment practices accordingly. Needs on both sides are urgent and require technical assistance support, as well as the acknowledgement that both businesses and lenders will need time to adapt. Suitable pools of capital must be created to underwrite these initiatives, and learnings must be better gathered, shared, and disseminated. Box 25, Business Development Support Services for SMEs, Learning from Best Practices. Business Development Support, BDS, is integral to helping SMEs grow and mature. BDS covers a wide range of training, mentorship, and capacity building activities that range from helping enterprises better understand their market and gauge demand to overseeing a budget, managing inventory, and complying with regulation. Depending on how they are provided, they can enable enterprises to tap into a network of peers or partners and increase access to funding opportunities or to pools of talent. Enterprises that have received BDS support are perceived by capital providers to be less risky and better equipped to generate or raise revenue and run a business. BDS support organizations have been proliferating, expanding the range of support services available to SMEs and the actors underwriting and administering them. In practice, BDS support services differ vastly in terms of effectiveness and cost efficiency, and with wider availability and quantity of services, focus must be placed on the quality of programs to ensure that they have the intended impact of building well-run businesses and boosting job creation. Fortunately, new efforts are underway to better segment BDE models and determine their effectiveness. The Scale Toolkit developed by the Argidius Foundation, for example, guides BDS providers and funders on how to implement practices that improve the effectiveness of BDS programs. A subsequent study produced by ISF Advisors, focusing on BDS providers for agri-SMEs in Africa, found that peer-to-peer BDS approaches have the potential to increase impact and reduce the cost of support. It also called for better data collection on outcomes to gain further insights into program effectiveness. Local fund managers are purchasing above their weight to finance SMEs at scale. Micro and small enterprises are often too small and too risky for DFIs and institutional investors to invest in directly. This has led to a shortage of growth capital for small and growing businesses. In light of the sustainable development and just transition challenges that lie ahead, addressing this issue more effectively would make a significant impact. This is the thesis of the Collaborative for Frontier Finance, CFF, which sees the need for more domestic fund managers to spur economic growth and create positive impacts aligned with the SDGs. Their local capital provider network supports a critical and missing piece of the market building puzzle. Fund managers managing less than $20 million and investing $50,000 to $500,000 in businesses poised for growth. Debt versus equity. Zoom in on best-in-class models for SME financing. The sustainability of traditional venture capital models has been contested, both for local fund managers and SMEs. The Argidius Foundation has conducted research looking at the best ways to finance SMEs at scale. Whether and under what conditions commercial bank financing is ideal for growth capital for EMDEs, SMEs, and when equity capital is managed by smaller fund managers is optimal. The KCB Bank, headquartered in Kenya, developed a new specialised SME lending programme, developed with the Women's World Banking NGO with support from Argidius. The initiative found that better segmenting the SME market, specifically the existing SME portfolio of the bank, and providing business development support services to its clients allowed the bank to better design products and provided more targeted services. This in turn generated growth and success among women-led SMEs, a previously underserved segment. In 10 years, KCB's loan portfolio is slanted to grow from $4 million in 2017 to $2 billion in 2027, with $500 million already deployed in 2022 across 13,000 loans. On the equity side, while the private equity and venture closed-end fund models have worked in developed economies with larger deals, they are arguably less appropriate for underwriting and managing smaller transactions, argues CFF in its ITF input paper. Sized and managed appropriately, however, equity financing is still greatly needed to support the growth ambitions of smaller scale businesses. In the coming year, respondents to CFF's annual local capital provider survey are seeking to raise $1.5 billion for small and growing businesses in Africa and the Middle East. As they and others working in the space recognise, local capital managers possess knowledge of the local ecosystem, customers, market needs and supply chain, and must be supported to leverage these factors to achieve further market development. On the topic of gaps in CFF's network alone, fund managers in Africa and the Middle East are looking to raise and put to work $1.5 billion in the year ahead and are not allowing the lack of early stage growth capital to deter them. As they seek to build a market, fund managers are getting creative about building compelling businesses even in the absence of capital. CFF's 2023 Annual Loan Capital Provider Survey details how local capital providers are working at the forefront of an evolving asset class to address the missing middle financing gap between $1,000 and $1 million facing small and growing businesses. Using pioneering combinations of vehicle structures, investment instruments, and partnership models, they are able to address the specific growth capital needs of small businesses and EMDEs. Other programs are also working to address the resourcing and capacity gaps facing smaller ticket local fund managers. Through peer-led support networks, fund managers are positioning themselves as a bridge between locally led solutions developed by SMEs and domestic institutional investors, pension funds, and commercial and national development banks. Box 27, examples of capacity building programs for local fund managers. The Collaborative for Frontier Finance runs a 100-plus member early-stage local capital provider network, which provides opportunities for peers to work collectively to find innovative solutions to the resourcing and financing challenges. The International Climate Fund Accelerator, or ICFA, which is based in Luxembourg, a 2-year acceleration program for climate finance fund managers, has trained 34 fund managers through 7 cohorts, providing opportunities for fund managers to gain skills and network to fund the next generation of green businesses locally. To date, the emerging fund managers supported by the initiative have raised $937 million in finance climate-oriented projects. 2X Global has provided guidance for women fund managers, and many DFIs have offered capacity building support to investees. Capria is a global venture capital platform helping early growth tech firms in Southeast Asia, India, Latin America, the Middle East, and Africa to raise capital. In addition, intermediaries are being set up to pool impact capital and accelerate the growth of the market. Over the past few months, countries such as Australia, Canada, Ghana, Nigeria, and Spain have committed to inject a combined $1.5 billion into local wholesalers and funds of funds. Learning from the model of Big Society Capital, the UK's Impact Investment Wholesale Fund, that has played a leading role in scaling fit-for-purpose financing for UK social enterprises, startups and SMEs, helping to channel $11 billion into UK small and medium enterprises. Zoom in. A GSG-affiliated NABs are developing national solutions to grow local financial intermediaries that can invest in SMEs and the SDGs. The Global Steering Group works with national partners in more than 50 countries to accelerate the flow of capital towards impact. To address some of the issues around financing the SDGs in emerging markets, the GSG and its national partners, called National Advisory Boards or NABs, are actively working to change policy and build pools of impact capital to improve SME finance in Ghana, Nigeria, Zambia and other EMDEs. However, structuring these vehicles is costly and challenging because of the double imperative of making them commercially viable, for example, attractive for local pensions and other private investors, and also designed to deliver impact at scale in less developed capital markets, where a range of risks and liquidity concerns apply. More resources are therefore needed to support the design of such vehicles with financial or non-financial resources, alongside technical and capacity building support to enable the blueprinting and dissemination of such locally grown and relevant solutions. Ghana, C-GABA Fund of Funds. The C, that's CI, GABA Fund of Funds, is a $75 million blended financial vehicle that will provide funding for West African venture funds and SMEs. 70% of the fund will be aligned locally and focused on investing in SMEs in sectors aligned to SDGs. The use of local currency is designed to encourage local market development and capital mobilization from Ghana's pension industry. The vehicle consists of 2 tiers of capital, a senior tier structured as preferred shares with return expectations based on the 10-year government bond rate, and a second tier covering a percentage of the first loss from donors or DFIs. The vehicle will be managed by Savannah Impact Investors. It is sponsored by Impact Investing Ghana with support from the GSG, FMO Ventures and the Research and Innovation Systems for Africa Fund of UK International Development. In Nigeria, Wholesale Impact Investment Fund, WIIF. The Wholesale Impact Investment Fund is a $1 billion fund with a first close of $100 million that is being set up to finance social enterprises and micro, small and medium scale enterprises in the agricultural, education, health, energy and creative industry sector with climate and gender as cross-cutting topics. In May of 2023, the Nigerian Ministry of Budget and National Planning pledged to contribute 50% of the fund's first close, $50 million. 90% of the fund will be Naira denominated, while the remaining 10% will be dollar denominated. The fund will invest through intermediaries and will provide equity, quasi-equity, debt, guarantees, technical assistance and grants. It is envisioned to be set up as a Sharia-compliant fund. The WIIF is supported by the Nigerian NAB with learning and research support from the GSG and design funding from GIZ, the German Development Agency. Zambia Credit Risk Guarantee Scheme. Zambia's NAB and the Bank of Zambia are collaborating to design a $150 million credit risk guarantee scheme that will provide low-cost credit to formal and informal SMEs operating in the agricultural value chain. Through a grant supported by the C3 Collaborative, the NABII and partners, including GSG, the Collaborative for Frontier Finance and USAID EDGE are working to assess demand and supply side gaps in order to create a mechanism that would meet the needs of commercial banks to expand and extend their lending portfolios. Turkiya Impact Fund of Funds. The Regional Venture Capital Financial Support Programme for Impact Investment is a $14 million impact fund of funds that will support existing and newly established funds deploying capital to high-growth ventures, generating a measurable social and environmental impact in the areas around Ankara and the provinces affected by the 2023 earthquakes. Launched by the Ankara Development Agency in 2022, the agency will contribute up to 25% of the total commitment size to eligible VCs. In Asia Pacific, Australian Development Investments, formerly EMIIF. The Emerging Markets Impact Investing Fund rebranded in August 2023 as Australian Development Investments or ADI, and it's a $250 million Australian government-backed impact wholesaler that supports SMEs and projects in Asia Pacific. The Australian NAB was active in promoting both its renewal and expansion. Strengthening the regulatory environment for the benefit of SMEs. Besides championing greater funds and more effective financing instruments for SMEs, broader systemic reforms are needed to create an enabling environment that is truly supportive of SMEs. To back this effort, domestic policymakers and regulators can pursue tangible steps to enhance the regulatory and government environment that would enable more domestic actors to channel capital in support of SMEs. Specifically, central banks and ministries overseeing SME activities and finance can institute the following reforms that would have a lasting impact on SME growth and access to finance. Recommendation 1, providing a market-wide definition of micro, small and medium enterprises. The lack of a definition for what constitutes an SME creates confusion among market actors. See box 29. Zambia's Ministry of SMEs issues official classification. The lack of official guidance on what constitutes a micro, small or medium enterprise led most commercial banks in Zambia to develop their own proprietary classifications to define these segments. This has made it difficult for national authorities to gather aggregated findings on the key characteristics, policy and financing gaps facing small businesses. Fortunately, a standardised definition was finally adopted thanks to a newly established Zambian Ministry for SME Development. It outlined 4 criteria: turnover, number of employees, legal status, and capital investments, against which the 3 categories of businesses will be determined. An example of turnover amounts within the new classification is provided. I won't go over those, but it divides between a micro, small, and a medium business according to the turnover in local currency. Banks are aligning their lending segments to the newly definition, providing access to better and more transparent data for national authorities who can in turn use this information to develop policies and funding instruments that can better meet the needs of the different business segments. SME registration. While official numbers are hard to come by, it is estimated that 1/3 of low and middle income countries' economic activity is generated in the informal sector, covering about 2 billion workers, or 60% of the world's employed population. That's an incredible number. Moving businesses from the informal to the formal sector is an important step in reducing poverty and ensuring inclusive business practices. Business registration initiatives are important as they provide data for national entities and help to generate tax revenue. COVID-19 served as a catalyst for registering businesses, since in many countries, only businesses that were registered with the tax authority would be eligible for aid relief. The Nigerian NAB was instrumental in helping to register 250,000 informal enterprises as part of the government's COVID-19 Survival Fund, a 75 million fund designed to support distressed SMEs. More initiatives like these are needed to incentivise enterprises to enter the formal economy, which will in turn help governments set favourable policies and financing opportunities to meet their needs. Credit Bureau enforcement of loan payback bankruptcy laws. Governance and enforcement of credit reporting, both positive and negative, is especially important when thinking about SMEs. Data managed by credit bureaus helps to reduce uncertainty about borrowers' creditworthiness, allowing banks to extend appropriately sized loans. These institutions add to a culture of accountability within the lending sphere, helping entities roll out new lending programs over the long term. IFC runs a credit bureau program aimed at helping central banks to set up and maintain national platforms to collect credit and payment history. To date, the program has helped to establish credit bureaus in 8 West African states: Benin, Burkina Faso, Ivory Coast, Guinea, Mali, Niger, Senegal, and Togo. Linking MDBs and DFIs to domestic capital mobilisation initiatives to enhance support for SMEs. As demonstrated, growing gaps and a rapidly changing planet require an all-hands-on-deck approach by all stakeholders to mobilise capital at pace. From where we sit, we see particular opportunities for MDBs and DFIs to strengthen cooperation and support local actors and initiatives to channel capital more effectively and efficiently for the SDGs. These efforts include helping domestic institutions to de-risk their investment in SMEs through the establishment of emerging market private debt funds and guarantee schemes, growth equity funds, or impact investment wholesalers. Facilitate de-risking initiatives with clearer SME finance and SDG impact outcomes. One way for DFIs to channel capital to the SMEs is to do so via guarantee schemes. Guarantees to support local currency lending for SMEs have been rolled out by DFIs in cooperation with public institutions, ministries and central banks, and as well as with commercial entities like commercial banks and microfinance institutions. SME guarantees have been criticised in the past for not providing sustainable solutions to EMDEs. 2 key problems lie in the fact that loans must be paid back within the guarantee period, which is often challenging for SMEs in certain sectors, and once the guarantee period is up and incentives and safeguards are removed, commercial banks are no longer incentivised to continue their lending programs. To ensure they are sustainable, guarantees need to be designed as holistic schemes that integrate business development services, technology solutions, value chain, and regulatory reforms. Additionally, commercial lenders must commit time and resources during the guarantee period to ensure the lending programs become key facets of their corporate offerings. Examples of bond funds and guarantees enabling local lenders to extend credit to SMEs and build a sustainable pipeline are shown below. And I'm actually going to skip this particular box 30, because I think it's again going quite into detail. But that, for those who want to read it, can be found on page 47 of the report. Co-designing and investing in catalytic capital approaches. Given the high level of corporate debt that has followed the COVID-19 pandemic, combined with higher costs of capital due to interest rate hikes in advanced economies in the past few years, the credit environment surrounding SMEs has become tighter. More instruments that blend public, private, and in some cases philanthropic capital are needed to encourage financial intermediaries to expand their lending to SMEs. Catalytic capital has been shown to be an essential tool to bridge capital gaps. Catalytic approaches warrant further expansion and resourcing from all organisations. They have the potential to help investors better understand the financing gaps, generate new pipeline, and contribute to local capacity. DFIs and institutional investors especially stand to benefit greatly from enhanced market opportunity by providing first loss tranches in new funds and technical support to build the management skills and capacities of fund managers. Box 31, Catalytic Capital Funding Platforms and Programs. C3, the Catalytic Capital Consortium. The MacArthur Foundation, in partnership with the Rockefeller Foundation and Omidyar, committed $150 million to support the design and development of investment instruments funds that address some of the world's most pressing challenges. C3 aims to demonstrate the power of catalytic capital to extend and deepen the reach of the impact investing field. Its in-depth learning library provides invaluable resources and evaluation studies on the topic. Now in its 5th year, its support has, among other things, helped to design the first forest resilience bond and an impact investment model to tackle the needs of informal settlements, a GSG-led project. The consortium has also provided funding to design a credit risk guarantee scheme on behalf of the Bank of Zambia, a project co-led by NABII Zambia, the Zambia National Advisory Board for Impact Investing, GSG's affiliated national partner. MasterCard's Foundation Africa Growth Fund. MasterCard Foundation Africa Growth Fund is a private-led catalytic fund of funds initiative that supports narrowing the gap in impact investment for growth-oriented African SMEs. The initiative will invest $150 million in African investment vehicles committed to advancing gender equity in entrepreneurship and $50 million in business development programs to de-risk those vehicles, aiming to enable 30 million young people to access decent work opportunities by the year 2030. FSD Africa is a regional development agency funded by UK aid that delivers policy and regulatory reform and capital strengthening to address systemic challenges within Africa's financial markets. It also invests risk capital in cutting-edge ideas with potential for significant impact. FSD Africa aims to leverage investments of $153 million to mobilise over $2 billion for projects that address both climate change and the needs of low-income, marginalised groups and women between April 2021 and March 2026. Convergence Design Funding Platform. Convergence Design Funding Platform offers a unique market acceleration opportunities for practitioners to secure feasibility studies and proof of concept stage funding to develop and launch catalytic blending finance vehicles that aim to attract private capital to sustainable development at scale. Recent opportunities include grants to design the Fund for Climate Resilience in Asia and the Indo-Pacific region, sponsored by the Australian government, a programme by UBS Optimus Foundation to support financing mechanisms to improve financing for tertiary education, and catalytic blended finance solutions for emerging markets, sponsored by Global Affairs Canada. In 2022, Convergence and USAID published the Action Plan for Climate and SDG Investment Mobilization, which outlined strategies for MDBs and DFIs to enhance the deployment of catalytic financing, emphasising the needs for shareholders to establish key performance indicators to align these institutions with the 2030 agenda and prioritise the mobilisation of private investors. Their action plan lays out a mobilisation blueprint for development stakeholders, including increasing the supply of flexible catalytic funding by crowding in a larger universe of resources and innovation, make MDBs and DFIs catalysts of mobilisation, maximise the investable pipeline through more integrated development and climate finance systems, provide investors with access to the best investment data and mobilisation resources, and empower local capital markets and financial intermediaries. Box 32, Impact Investment Institutes, Bridging Divides, a guide on using catalytic capital for a just transition. A paper released in November 2023 by the Impact Investment Institute, the GSG affiliated UK NAB, provides guidance and case studies for catalytic capital providers, including development finance institutions, governments, philanthropic organisations, private investors and corporations seeking to mobilise private capital for a just transition that combines climate action with social justice and local development needs. Box 33, Blended Finance for SMEs, Fostering Shared Learning Opportunities Between Developed and EMDE Markets. A new collaboration between Big Society Capital and the European Bank for Reconstruction and Development is sharing learnings around financing models for SMEs sourced across developed and developing countries, broadening the toolkit of models that can be implemented or iterated upon according to country context, available opportunities and constraints. Village Capital has also developed an innovative finance tool called Capital Explorer, providing access to descriptions of innovative financing vehicles that are fit for purpose for social enterprises and micro, small and growing businesses. Other examples include the Climate Policy Lab, which focuses on the development of new climate finance instruments, and Anglo American, which is looking to apply catalytic capital to designing new investment instruments for South African SMEs. Box 34 zoom in on catalytic capital to provide access to tech-enabled solutions. Better access to technology has the potential to play a significant risk mitigation role that can benefit SMEs both from a financial and environmental sustainability perspective. Financial sustainability. Today, there are an estimated 1.6 billion registered digital money accounts, with the number of accounts and amounts transferred growing 13% and 22% respectively year on year. Financial technology is helping SMEs to maintain a data trail of transactions, facilitate payments, and widen market access, among other benefits. Lending platforms enabled by fintechs have the potential to reduce the number of non-performing loans. Technology is also making insurance for SMEs affordable and accessible for the first time, thereby improving entrepreneurs' willingness to pay, an important advance in light of the many market, currency and climate-related risks facing SMEs. Environmental sustainability. Technology is helping SMEs in climate-vulnerable sectors to gain added control of their environment, helping them plan in advance, utilise resources more efficiently, and optimise production, contributing resilience not only to employees but to their entire value chains. Greater access to climate technology stands to benefit both SMEs and capital providers. From a capital provider perspective, these actions help to mitigate information asymmetry and performance risks. In developed countries, early subsidies provided by public entities or angel investment have been shown to have a demonstrable effect on the future growth of SMEs. Public programs in the form of grants, including match funding and convertible loans, have been shown to provide SMEs with a solid base to develop operations. Catalytic capital can help domestic investors and government actors alike integrate technology into their investment and risk mitigation processes. Despite up to half of their portfolios being made of financial intermediaries, DFIs have not adequately prioritised investing in domestic impact fund managers, missing opportunities to build up local capital markets that can enable SMEs to access capital when they require it and in the form needed to grow. Experts acknowledge the role DFIs have played in developing private equity and venture capital in emerging markets by backing new fund managers, but believe they can do more to invest in local fund managers, especially smaller funds. They also see the need for more transparency on the impact of their investments via financial intermediaries, which would lead to a clearer demonstration of SDG outcomes achieved through such investments. DFIs can also engage more actively by supporting business development support services and using these platforms to source new pipeline opportunities. This ensures entrepreneurs are exposed to sound social, environmental and governance practices even from an early stage. Accelerator programs also adequately prime entrepreneurs for commercial success through effective managerial and operational training. Amidst the critique, DFIs have initiated programs to boost their involvement in venture capital investing, and in the last 2 years, DFIs have launched catalytic financing programs. Most are still new and learnings are still emerging. Box 35, DFIs launch programs to support SMEs and domestic fund manager development and investment. Growth Investment Partners Ghana is a local currency financing vehicle launched by BII in July 2023 with a commitment of up to $50 million. The vehicle aims to provide long-term capital that addresses a financing gap in Ghanaian SMEs, which account for over 80% of all employment. The vehicle will directly support up to 150 SMEs in Ghana over the next 15 years. Prosper Africa is a US government program designed to help businesses and investors gain access to government grants, loans, and other financing opportunities sourced from 17 US government agencies. To date, it has helped to close 1,236 deals between the US and African countries, amounting to $70.8 billion worth of investment. In August of 2023, the program announced the Prosper Africa Catalytic Investment Facility, which will co-invest in 10 plus African fund managers. The program currently supports 10 African fund managers, including an accelerator program for first-time female fund managers, a female-led fund deploying capital into medium-sized enterprises in the high-growth sectors of food, climate, health and education in East Africa and Zambia, as well as a pre-seed impact fund and accelerator that will catalyse capital into high-impact tech startups working in the climate space. Box 36, IFC's commitment to invest in best-in-class first-time fund managers. To help develop emerging fund managers, IFC invests a substantial proportion of its funds with new fund managers. During the early 2000s, IFC supported many first-time private equity or venture capital funds in nascent markets with little previous PE/VC fund activity. IFC's investments in first-time funds outperformed global benchmarks and, as shown, also outperformed IFC's investments in follow-on funds in more established markets. Mobilising growing sources of domestic investment relies on many of the same considerations as drawing international institutions into EMDEs. For example, domestic pension funds also require de-risking, with DFIs and MDBs able to offer the guarantees and first loss capital that can facilitate their investment. However, it is also essential to recognise the differences in mobilising international capital sources. Domestic private investment ecosystems are relatively undeveloped, with investors requiring more education and again data on investing in alternative assets such as infrastructure and SMEs than their developed market peers. And while local fund managers are among the best placed to understand the landscape and needs of their domestic markets, they also need assistance with capacity building with the creation of a fund of funds and other vehicles that can bridge the gap between large investors with sizable capital to deploy and SMEs with smaller investment requirements. Developing and leveraging domestic investment is an essential part of the private capital mobilisation puzzle. Capital needs to be encouraged to flow internationally to meet the SDGs and ensure a just transition in EMDEs, but for that to happen, many international investors will want the reassurance of domestic pension funds and other institutional investors supporting opportunities on their home turf. Recommendations for investors and governments: better support the development of investable opportunities. This can only happen with strategic and concerted efforts to back businesses with high impact and high growth potential, alongside innovations in local funds with the potential to scale capital flows towards them. As in developed markets, this requires public subsidies and grant capital. MDBs, DFIs and catalytic capital providers support domestic initiatives such as the ones led by GSG affiliated national advisory boards working to deploy locally designed solutions at scale. Specifically, increase the supply of catalytic capital available to boost such solutions through, for instance, the creation of regional catalytic capital facilities. Domestic EMDE investors unlock domestic capital for the SDGs. We know that domestic, public and private capital may not be sufficient to achieve the SDGs. However, while collective work progresses to revamp the global financial architecture towards a just and sustainable world, it is essential to focus efforts on unlocking capital most proximate to needs from PDBs and domestic institutional investors. Finally, we have the conclusions and recommendations for this whole paper: increasing risk appetite and supporting domestic collaborations. We have polished the problem long enough. Common ground has been established around what needs to be done, most notably reform of DFI and MDB mandates and greater risk mitigation for private capital. There is now consensus within the G20 and other high-level forums about the need to implement difficult but essential shifts if we are to achieve the SDGs by 2030. The solutions to help channel significantly more private capital towards the SDGs are known. There needs to be an active push at all levels to disseminate and implement those solutions at scale and with urgency. Specifically, we call on investors, DFIs and MDBs, donors and others too. And then again, this is broken down by who it's addressed to. So let's start with the first one: MDBs, DFIs and investors. Support and invest in domestic initiatives led by coalitions and EMDEs, such as those led by GSG NABs. This includes increased support, especially subsidised or grant-funded capacity building and technical assistance for local business development, local early-stage impact funds, efforts to launch domestic impact funds, attracting domestic capital investments, and the structuring of new assets, with a focus on countries with significant need and/or mobilisation potential. The increase in the supply of catalytic capital will help to boost the deployment of such local solutions, for instance through new regional catalytic capital facilities. MDBs, DFIs and investors. Invest in and deploy existing solutions for a just transition and SDGs. Green, social, sustainable and sustainability linked bonds, insurance or securitization of DFE assets, dialing up the amounts available for guarantees, recapitalization, or replication of successful facilities like MIGA, MCCP, PIDG, or TCX, and the more efficient deployment of de-risking instruments are already available and will lead to higher amounts of institutional capital flowing to the SDGs in EMDEs. The de-risking solutions exist but need to be implemented at scale, more frequently by MDBs, DFIs, and PDBs. In turn, private investors need to get out of their comfort zones and stop waiting for MDBs and DFIs to systematically de-risk their investments in EMDEs. Numerous profitable opportunities are investment ready and will lead to attractive returns. MDBs, DFIs, and their shareholders develop and implement mobilization strategies for DFIs alongside ambitious targets and accountability towards them as part of DFI mandates and operations. This can significantly move the needle for private capital mobilization overall from less than 1x, closer to an ideal, although as yet unrealistic, 10x. The setting of such overall targets should start with a more sophisticated approach to capital mobilization, with much clearer strategies about whether and where to pursue capital mobilization targets or market building objectives. There should also be clearer setting of targets for DFI business segments, coupled with more focus on and support for the demand side of such investment. Finally, for MDBs and DFIs, unlock data and evidence, specifically data housed in the GEMS database, to enable investors to develop a better understanding of which investments are most impactful. All the other actions highlighted above can be significantly accelerated if more data is made available at all stages of the process. Data and a better understanding of success factors for capital mobilization will inform key considerations such as the relationship between risk and reward, development impact and mobilization, as well as a portion of DFI portfolios or balance sheets that should be used for capital mobilization. Speed and scale are the two most important considerations. Solutions must be implemented that can draw in investors who are most proximate to the needs, whilst all actors need to step up to the mark and take more risks in the investment process. So that brings to a conclusion this report in its entirety. In fact, after this, there is a glossary containing some of the terms that were covered here, list of contributors, and there is a couple of, then we have of course the footnotes, and that's basically it. So I'm not going to read those because I think that again is extraneous detail for most people listening. Thanks for sticking around for those who made it all the way through this report, and if you would like to reach out to me for suggestions for more reading material, not that there's not enough already on my in tray, consider contacting me at public@danielrosehill.com. Rosehill is spelled Rosehill. Feel free also to connect on LinkedIn, and thank you for listening to this episode.